Hi, Professor Rex here. My college accounting students love tech stocks and love using what they learn in my accounting classes to pick stocks to invest in. So on April 29th, 2024, I started depositing $12.50 a week into a brokerage account, and we buy 10 different tech stocks each week. We invest only a small amount each week because I wanted to show my students that they don't need much money to start investing. This graph is showing the growth of our tech stock portfolio over time as I invest additional funds each week. We have other portfolios too, including dividend portfolios, which are my favorite. So check out my other videos for information on them. As you can see, lately the portfolio has hit a wall as multiple announcements of new tariffs have really spooked the market, causing the S&P 500 to fall 10% from recent highs at one point, putting us into correction territory. Now, if stocks fall 20% instead of 10% from their recent high, then it's officially a bear market. But we aren't there yet. And if you're new to investing, these corrections, which again are 10% drops, and bear markets, which are 20%, are actually pretty common, so don't freak out. There are timestamp links in the description of the video in case you just want to jump to a list of stocks we bought last week or any other section of the video. The S&P 500 has fallen 8.2% from recent highs and at one point was down 10.1%, putting us in a correction. Tech stocks have fallen 12.1% as measured by the most widely traded diversified tech ETF, which has a ticker symbol XLK, and dividend-paying stocks, as measured by the ETF with a ticker symbol SCHD, have fallen 7%. Studies show that dividend-paying stocks outperform non-dividend-paying stock, especially in down markets. Now, our two dividend stock portfolios have fallen about half the amount of the S&P 500, with our high yield portfolio doing the better of the two, since it has much less allocated to the technology sector, less than 1%. Things would have been a lot worse this week, but the market bounced back on Friday with the S&P 500 jumping over 2% and tech stocks surging 3% after an apparent agreement in Congress to fund the government through September 30th. Now, according to the Center for Financial Research and Analysis, since 1990, the market has had 12 declines in the range of 10 to 19.9%. So 12 corrections. In the following 6 months after those corrections, the S&P 500 rose an average of 22%. And the three sectors that fell the most during the correction rose an average of 27% in the subsequent rally. This could be good news for tech stocks. What's uncertain about this possible rally is its duration, since the major headwind, which is tariffs, has yet to be resolved. But those could be removed with just a single announcement. Before we talk about our tech stock portfolio in depth and our capital light portfolio and our Wide-Moat portfolios, let's look at what happened recently and what's coming up this week. So last week, 2 inflation reports were released, and both came in better than expected. So last week could have been even worse than it was if those reports hadn't been good. And not surprisingly, the University of Michigan's survey of consumer sentiment fell for the third month in a row as consumers are spooked by tariffs and the possible increase in inflation that they might cause. Now, next week, we got some things coming up that are important. On Monday, a report will be released showing February retail sales. And on Tuesday, the report showing the number of houses that were starting to be built will be reported. Both will be a good glimpse into the state of the economy. And even more importantly, on Wednesday, the Federal Reserve will meet, and then Federal Reserve Chairman Powell will have his press conference. What he says about last week's 2 inflation reports could be a big clue if we're going to get any more interest rate cuts this year, which would definitely make Wall Street happy. Here's a usual disclaimer. This presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own due diligence, which is a fancy phrase to say do your own research. Now let's talk about the tech stocks we bought at the beginning of last week. On this slide are our ratings for the top 15 tech stocks as of last Monday. I posted these rankings to our website, beatthestockmarket.com, last Monday. Then we purchased the top 10 stocks. Note that these stocks are higher quality, meaning that they must have a quality ranking of B- or better. More on what makes up our quality grade on the next slide. Also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend growth stocks, because some tech stocks do not pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratio, etc. So our highest rated tech stocks last week were Taiwan Semiconductor, Adobe, Applied Materials, Microsoft, Arista Networks, NVIDIA, ServiceNow, Broadcom, Synopsys, and ASML. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio. Risk is the first quality component. Tech stocks, by their very nature, tend to be riskier than most other sectors. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital and general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits. And finally, the last quality component is financial health. Remember, the risk rating is comparing these stocks to other stocks, not to other investments like bonds or CDs. Now, one reason why tech stocks have been outperforming the market for the past 2 decades, might be because they tend to require little capital. As a simplified example, if you want to start a software company, you just need a computer and software knowledge. On the other hand, if you want to start manufacturing cars or jets, you're going to need a lot of buildings, a lot of equipment, a lot of employees, etc. In other words, a lot of capital, which is very expensive to obtain and maintain. Now, Goldman Sachs recently published a research note that shows that companies that do not require a lot of capital have significantly outperformed companies that employ heavy capital during the period of 1990 to 2024, and it's not even close. The research calculated capital intensity based on 3 formulas: assets divided by number of employees, assets divided by net income, and capital expenditures divided by net income. So you can use those 3 formulas on your own to see what is considered capital-light companies. We find this research to be very intriguing and come up with a way to see which companies currently require little capital and are also of high quality, seem to be undervalued, and therefore look to be great potential investments. But first, let's look at a list of the S&P 500 companies that are considered capital light according to the Goldman Sachs study. Once again, the formulas the Goldman Sachs study used were assets divided by number of employees, assets divided by net income, and capital expenditures divided by net income. And since the study covered a 34-year period when growth outperformed value, on this slide, just for fun, I added a valuation column, which in this case is based solely on a growth methodology instead of our usual combination of 2 methodologies, one being growth and the other being deep value. But on the next slide, I'll show you which stocks we think are the best potential investments at this time. Remember, this is just ranked by rank of capital intensity. So Rollins Company is the least capital intensive company in the S&P 500. On this slide, I have a list of S&P 500 companies that are capital light, high quality, and appear to be undervalued using a growth methodology. So far, this strategy is ahead of the S&P 500 because we are investing in these stocks in a separate portfolio to track the performance of this strategy. But it's very early in using this strategy, so who knows what's going to happen in the long run. But so far, so good. Now, the Goldman Sachs study did not specifically state what constitutes a capital-light company other than those 3 formulas. In other words, did the study deem half of the companies to be capital-light and the other capital-intensive? I'm not sure, as I've not found more details of the study. If you can find details of the study, please share them with me. I chose to consider the companies with a rank of capital intensity from 0 to 30% to be considered capital light. So as you can see in this column called rank of capital intensity, none of them are at 30 or higher than 30%. In fact, the highest one here looks to be Apple with 20%. So for this slide, I started with a list of over 4,300 companies, and the first step was to filter out the companies that were capital intensive. I deemed that the companies had to be in the first 3 deciles to be capital light. In other words, they had to be in the first 30% of companies were ranked from least capital intensive to most capital intensive. Then I filtered out all stocks not in the S&P 500. Then I ranked them based on a combination of our quality grade and their valuation. And on this slide, we have the top 15 companies. The top 10 are Chipotle, Adobe, Accenture, Amphenol, MSCI, Arista Networks, Hubble, Applied Materials, MasterCard, and Lowe's. And let's talk about our wide moat strategy. So here's a strategy I started tinkering with behind the scenes in September of 2023. It's not the most diversified portfolio, so I decided to wait longer to share the results. It's a wide moat stock strategy. First of all, what is a moat? Well, Morningstar is a service that rates stocks and is famous for its moat rating that it assigns to large companies. So what is a moat rating? A moat rating attempts to simply measure the competitive advantages of a company. If a company has no competitive advantages, then it's very easy for another company to enter the industry and take customers away from that company. They call it a moat rating because they liken it to a moat around a castle. If the moat is physically wide, then it's hard to storm that castle. If the moat is narrow, then it's a bit easier to attack the castle. And if there is no moat, then the castle is much easier to attack. So this strategy invests only in the companies with the best competitive advantages, in other words, the widest moats. There are limitations to the moat rating, and I prefer my own quality ranking that takes much more data into consideration, but the moat rating is kind of a quick shortcut way to invest in only high-quality stocks. On the next slide, you'll see my ranking of the top 15 companies with wide moats. But first, let's look at the strategy's performance. Like the tech stock portfolio, I've been making weekly investments into the portfolio. I originally had this strategy in a Fidelity portfolio with a few other strategies, but I quickly learned that having several strategies in the same account makes for a nightmare to track their performance separately. So I sold off those holdings and have since started a Fidelity account dedicated solely to this wide moat strategy. The average investment so far has been held for 194.6 days and has produced a total return of 22.06% over those 194.6 days. Using Excel's rate function, that's an annual return of 46.59%. Now, the strategy doesn't result in a portfolio with as much diversification as most of our other strategies, so its performance could fluctuate a lot. Now, Morningstar offers an ETF that only invests in wide moat stocks. So that ETF is a natural benchmark. Benchmark just means a comparison for this strategy. Its ticker symbol is, not surprisingly, MOAT, M-O-A-T. If we'd instead invested in MOAT on the same exact days that we invested into our wide moat stocks, we would have received a return of 11.37%. with the same holding period. Using Excel's rate function, that's an annual return of 22.4%. Still pretty good, but so far we're ahead of that. Our wide moat strategy is also beating the S&P 500 by 17.3 percentage points on an annualized basis. Now let's look at our list of best wide moat companies. In other words, the companies with the strongest competitive advantage. These ratings are as of last Friday after the market closed. The valuation methodology uses a growth methodology, not a deep value methodology or a combination of the two, just growth. The highest top 10 rated companies were Arista Networks, ServiceNow, Adobe, American Express, Constellation Brands, Chipotle, Marriott International, Hubble, NVIDIA, and the good old Amazon. So in the comments, let me know if you have any questions. And also let me know what portfolios or investment strategies you would like to see more of. And finally, here are the places you can reach me. YouTube, obviously, as well as our website, beatthestockmarket.com, LinkedIn, and Twitter. I'll see you again next weekend, likely with a list of dividend stocks we'll have purchased for our dividend portfolios on Monday. See ya!